Hello traders, you are welcome back to the Forex Geek channel. In this video, we are going to discuss a topic that is often overlooked but can be a game changer in your trading strategy, and that is the liquidity gaps. Okay, so have you ever noticed sudden price movements or price jumps with no clear reason? That's likely due to a liquidity gap. Now, these gaps can present amazing opportunities for traders who know how to spot and trade them. But first, what exactly are liquidity gaps and how can you use them to your advantage? Now, stick around because in this video, you're going to learn what liquidity gaps are and why they happen. You're also going to be learning how to spot liquidity gaps on your chart, how to trade them, and the best strategies to take advantage of liquidity gaps. Okay, so let's just dive into it. If you find this content helpful, don't forget to hit that like button, subscribe to the channel, and turn on notifications. Okay, let us get started. Now, a liquidity gap is a price gap, right? A liquidity gap is a price gap that occurs when the market experiences a sudden lack of liquidity, or when there is a sharp discrepancy between the buying and selling orders. This creates a space in price, like what we have here, where there is no trading activity or market participation. Okay, these gaps are typically caused by news events, economic releases, or after hours trading, when the market opens at a new price level without filling in the gap. For example, overnight gaps can occur when major news breaks and prices open much higher or lower than the previous day's close. So the gap you see on the chart is essentially a void in price where there was no trading. So think of it like a missing puzzle piece. And traders who understand how to trade these gaps can use them as part of their strategy. Okay? Now, how do we spot these gaps? Liquidity gaps, they appear on charts as unfilled spaces between price levels. The price will skip from one level. You can see in this scenario, can you see that we had a jump all the way from here to here, right? So the price will skip from one level to the next, and there won't be any price action in between. So how do you identify a liquidity gap on a chart? First of all, you should look for a sharp price move with no price action in between. Then secondly, observe the volume. Okay, we can actually decide to add the volumes indicator just to observe what happened around it, right? Now, oftentimes, liquidity gaps occur when there is low volume. So one of the things you are going to notice now is that, you can see there was some spikes in volume around this period. But when the liquidity gap was about to happen, can you see that there was low volume? Around this whole period, can you see that there was low volume? Okay. Or you will notice a sudden increase in volume. So those are the two scenarios. You might often find liquidity gap occurring when there is low volume or when there is a sudden increase in volume. Then you can check for news events. Liquidity gaps are more likely to appear after major market news. So once you spot a gap, it's important to analyze the context of the gap. Was it caused by a major news event or market sentiment shift? Understanding the reason behind the gap can help you decide whether it is a good opportunity or just a false move. Okay? So now that you know how to spot liquidity gaps, let's talk about how to trade them. Okay? Liquidity gaps can be used in a variety of ways to improve your trading strategy. Here are a few tips on how to trade them effectively. Okay? We have the gap fill strategy. Okay, that's one of the most common strategies for trading liquidity gaps. It is the gap fill strategy. Now, this strategy is based on the assumption that the price will eventually return to the gap and fill it. Now, when there is a gap, the market often retraces. Can we see that after this gap happens, eventually you can see how the price kept on coming down until it filled up this gap. Can you see that? Can you see that? So you can actually trade the gap fill by waiting for the price to move back toward the gap and enter on retracement. For example, if you see a gap up, you can wait for the price to retrace and then enter a short position. Once the price starts to fall back to the gap level, right, you can just enter a short position. Conversely, if you see a gap down, if it was a gap down, you can enter a long position once the price starts to rise back to the gap. So if you enter a short position, then you can exit at the time when the gap gets filled. So you can just exit around here. Okay? Then we have the trend continuation strategy. Another way to trade liquidity gaps is by following the trend continuation strategy. Instead of waiting for the gap to fill, you can trade with the trend. If a liquidity gap occurs in the direction of the prevailing trend, that is in a context where it occurs in the direction of the prevailing trend, because in this situation, we actually had a consolidation market. You can see this was actually a consolidation market, okay? But in a situation whereby a liquidity gap occurs in a strong uptrend, for example, or maybe in a strong downtrend, and you want to trade in the direction of the prevailing trend, then you might just follow the momentum and enter the trade in the same direction, anticipating that the price will continue moving in that direction. For example, if the gap occurs after a strong trend, you can consider entering a long position in the direction of the market. Okay, that is after the gap has already happened. If it was in the direction of a strong trend, then we want to look out for entering the trade after the gap has happened, right? And when you are noticing a continuation pattern, okay, please get a continuation pattern before you enter the trade. Then for risk management, while trading liquidity gaps can offer opportunities, it's important to keep risk management in mind. Like with any strategy, gaps don't always fill, okay? And price can continue moving in the direction of the gap. So stop losses should be placed just outside the gap area to protect yourself from large market moves, all right? When liquidity gaps can present great opportunities, it's important to know how to avoid common mistakes. The first mistake is jumping in too quickly. Sometimes traders see a gap and rush in without understanding why the gap occurred. So always check the reason behind the gap. Is it caused by a news event or something else significant? You should check that, okay? And do not ignore market context. Do not ignore the trend context. Gaps in the direction of the trend tend to have stronger follow through. So always check the overall trend before deciding to trade a gap, okay? Then the third mistake is not using proper risk management. Since gaps can be unpredictable, stop loss orders are crucial. Never trade a gap without a solid risk management plan. Now you know how to identify and trade liquidity gaps in your Forex strategy. Have you traded liquidity gaps before? Let me know how it went. And if you have any other strategies you like to use when trading gaps, drop a comment below. I'd love to hear from you. If this video helped, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss an important update. Happy trading, and I'll see you in the next video.